Hello, Southwest Florida homeowners and homebuyers. Welcome to the 239 Real Estate Roundtable podcast, your go-to source for navigating the vibrant real estate landscape of our beautiful region. I'm your host, Kevin Tremmel, a local real estate agent, leader, and investor here in Southwest Florida. On this podcast, we bring you insights from best in the business, top-notch real estate professionals, seasoned agents, and experts in everything from homeowners insurance to mortgages, maintenance, and repairs. Whether you're a first-time homebuyer or a seasoned homeowner, we've got you covered with tips, strategies, and valuable insights to make your journey in Southwest Florida's real estate market a breeze. Get ready to unlock the doors to successful home ownership. This is the 239 Real Estate Roundtable podcast, where we demystify the process, share insider knowledge, and ensure you're well equipped to make informed decisions. Let's dive in.
Hello, everybody. Welcome to another episode of the 239 Real Estate Roundtable podcast. Our guest today is Irwin Boris with Peykar Capital. Irwin is a seasoned real estate investor with a CPA and lender underwriter background. He has spent the last decade mastering cash flow focused investment strategies in industrial and small bay flex properties. I'm super excited for our conversation today. And welcome to the show.
Thank you so much for having me today. Thank you.
Awesome. Why don't we get started as we usually do here on this podcast? Irwin, why don't you tell us a little bit more about yourself, your background, how you got to where you are at today, and what it is exactly that you do today?
No, sure. My background is an accountant. That's where I have an undergraduate degree in. I took the CPA exam, worked for a medium-sized accounting firm, had a lot of real estate clients. And, back then, all you saw was a bunch of numbers. So when I got tired of practicing accounting, I went to work for a very large owner-operator in the New York area who let me manage buildings, taught me the management side. So I had, 5 buildings, 1,000 units, they were big buildings. I had to go to landlord-tenant court, collect rent for people that didn't pay, deal with federal and state agencies, as well as try to motivate your staff to do the right thing and the repairs the first time. And it really gave me an appreciation for what went into the numbers and how difficult it was sometimes to collect rent from some tenants and why expenses could vary greatly from one year to another. And, as an accountant, you're always trying to look for trends and see, all right, you understand 2 or 3% growth on all the line items, but some of these items were crazy from year to year. And that doesn't even include the capital improvements, which we typically look at below the line item. And so over the years, I've either worked for owners doing asset management or controllership financial work. With some, I've helped do a lot of acquisitions of multifamily, retail. I've worked on office buildings and hotels and industrial. And it was always interesting to see the different types of leases where sometimes the landlord had to absorb all the operating expenses, sometimes they didn't absorb the operating expenses, and sometimes the tenant were responsible for the operating expenses. And I guess that's what led me to where I am today. I like not being exposed to gyrating operating costs. I like anyone who's listening who had invested in apartments or owns residential knows what happened to property insurance costs the last couple of years. It got really ugly. And here in this asset class, there was a slight increase, but not what you saw on the residential side. And then again, the tenants either paid that 100% of the cost or they paid 100% of the increase. And so now I spend my time helping people invest for the long term and try to achieve, financial freedom and get rid of that W-2 job through investments in multi-tenant, industrial, and flex.
Yeah, awesome. And so I'm more on the residential side, but it's obviously no secret, and correct me if I'm wrong, but it's obviously no secret that industrial and flex, I think on the commercial side, has been over the last couple of years like pretty much the top sector when it comes to commercial real estate. Why do you think that is? Like, obviously we know about the challenges that office space is having right now, but what do you think is the reason for industrial and flex being pretty much top of the list?
Industrial and flex buildings have always been, a steady cash flow investment. They've always remained rather full. Many years ago, most people didn't look at them because they thought, manufacturing, it's ugly, it's dirty, and they were out of favor. And then I guess when you started reading about some of the larger institutional investors buying it, and then when people couldn't make money on residential or multifamily, everyone decided to go to an asset class that was easier. But if you think about it, you have everybody from people like, Amazon, who has monstrous warehouses as well as small ones. It could be Pepsi Cola, refrigerated boxes for food distribution, to a small tenants like, the plumber, the electrician, the painter, who need a space to do their office work, their paperwork, their billing, as well as a place to store their materials and their trucks. So it serves a lot of needs. And it's probably a lot in your local neighborhood that you never really looked at. It could be a 10,000 square foot building with one or two tenants in it, or a 50,000 square foot building with 3 or 5 tenants in it. And it was just taken for granted. So sometimes there are auto body shops in one of the spaces, car repairs. The reason we call it flex is it could be anything for any tenant. And in some larger flex building, you might have people use it for more of an office space because they don't want to be in a multi-story office building. They want their own 4 walls that they can control.
Yeah, for sure. And especially I mean, these flex spaces and these light industrial buildings where I live here in Southwest Florida, I mean, they are popping up left and right and everywhere. So, and then one thing I want to touch on. So you mentioned you work with investors to basically make them financially free, help them quit their W-2 job. So it sounds like you're not working with the institutional investor, the iBuyer, but really more like the average Joe, quote unquote. But can you shed some more light on like that business model? Like,
sure, absolutely. We've worked with single institutional investors over the years. The $10 million check is just to write the $100 million check. And when you're raising, $3 billion, a $10 million equity check is a rounding error. You can't get their attention. That, and I think that a lot of them just have unrealistic return expectations. They raise this money. They have no money of their own in the investments. And so for them to make money, it's all about fees and what the profit split's going to be at the back end. Where I work, where my interests are aligned with the investor, where we have real money in the deal alongside, sharing whatever the exposure is. And we're looking at deals that will always stay full, provide current cash flow, and over time will create wealth. So we can hold as long as the investors want to hold, whether it's 3 years or 5 years or 7 years or longer, where the institutions want to be in and out in 3 or 4 years. And a lot of times, they're not going to find deals that they could do, which is why so many of them are sitting with a lot of cash in the bank and haven't been able to get the money out the door.
Right. Interesting. Yeah. And is there like a minimum buy size, like for a private investor to join one of your investments?
Sure. Typically on the low side, as accredited investors, it would be $50,000. Sometimes it's more depending on the amount of equity that we're raising. People can invest either directly, they can invest through their IRA or retirement money through an independent custodian. I happen to have several doctors and dentists and other people towards retirement age that are looking at this. Great, I'm getting 9% a year. I don't care if you have a sell. It's better than I'm getting in the bonds. It's better than the bank is paying on my money. And here I'm getting the real estate tax benefits from depreciation. And the one thing I've learned over time is the hardest thing to do is get control of the deal and close it. And once you own it and you know it and it's performing, I'd like to think it's more advantageous to refinance and pull cash out and de-risk your investment over time than it is to sell it and try to have to figure that out all over again.
Right. Because then you're back to square one.
Then you're back to square one, and then everyone's got, and everyone says, oh, depreciation is great. It's great until the deal is sold and there's recapture.
Right.
So as long as you keep reinvesting it and you kick it down the road, you never have to worry about what the gain is. And when you pass away, your heirs get a step up in basis. So you can take the tax with you to your grave, so to speak.
Yeah, right. And then, so what advice would you have for someone? There's obviously some people that invest in real estate themselves, What advice would you have for someone, like, why is it more beneficial to work with someone like yourself rather than like, doing it yourself essentially? Like what
Well,
advice? Yeah.
sure. If you're doing it yourself, you're probably, unless you have a lot of money to invest, you're probably buying a much smaller property, and it might be, be one tenant, and you might not have the experience of the due diligence, even though it's a small tenant, you think you cover it all. We structure leases a certain way, so we have lots of, lead runway time if the tenant's not renewing to find a replacement. We know who we want as tenants. We know where we want to look as tenants. And then it also depends on what your investment goals are. For us, the investment goal is to provide cash flow, where some investors, whether they're doing it by themselves, they might say, well, I'm not going to get the cash flow now, but I think there's long-term value. Well, there's an old expression, man makes plans and God laughs. So the only thing you really know the day you close on an investment is what the cash flow is.
Right.
And so we look for investment properties that can distribute at least 7.5 to 8.5% in the first year, and then grow that over time. And so I think if you're looking for an investment vehicle, you're better off investing with someone that has a similar mindset.
Yeah, right. And the experience. And it sounds like you're a numbers guy through and through. So yeah, very interesting. And then what do you like more specifically? Like, what do you look for when you make these investments? So we obviously talk about the sector, industrial and flex, but maybe if you could shed some more light, like what are kind of like the best metrics for making those investment decisions?
No, sure. We look at a lot of buildings in a lot of secondary markets on purpose, because that's where the yield is. I'm not competing with Blackstone or BlackRock or Starwood or any of these other mega buyers. For them, they like shiny new toys you can put on the cover of the corporate book. Yeah, I just want to know it's going to stay full. So we look for tenants that are in specific locations for a reason, either proximity to major customers, major suppliers, major roadways, and sometimes the local labor force. I was involved in one transaction where it was a single tenant building in Indiana that employed 500 people in 3 shifts. They can't easily move, because if they move more than a mile or two in any one direction, they're going to lose a lot of their people. And so what I've learned over the years by talking to a lot of people, and even some of my peers, is we go in and talk to a lot of the tenants. And it's not normally in due diligence in residential, we'd be looking at what's the rent comparable, what are other buildings selling for, what are the other things renting for. That's part of the process. But for us, it's here is, how many people do you employ? What's the average tenure? How long do you think the commute is? And it gives me a feel for how sticky they are. And because we're also buying these buildings at a really a substantial discount to replacement cost, I know I could always keep them full, more so than the new building, which really needs to get a return on its investment, which is going to hold out for top dollar.
Interesting. Yeah. And do you also target buildings with value add? Because I know you said you buy them significantly under replacement cost, but so do you buy a lot of buildings like where can make some improvements and add value, or is that not so much part of the business model?
Yeah, there are some value adds, but it's not like you would think in residential where you're going to do a renovation.
Right. Okay.
Sometimes you can get a higher rent by giving more tenant improvements, depending who the new tenant is. We also look for buildings that have some upside in the rent. We look for buildings where the leases are all not triple net. That's the one I'm currently negotiating the contract on. They're all old gross leases, which means the ownership is absorbing 100% of the operating costs. And in that market, the tenants pay part of those costs. So over time, we will convert those leases. We'll also look at properties that may only be 80% occupied. And you sort of scratch your head and try to figure out, why is it only 80% occupied? And sometimes it's because the seller doesn't use leasing brokers. Sometimes they don't really care because they have no mortgage on the building. It's for a variety of reasons.
Yeah.
And so and then the last part of the value add is we look for properties on oversized pieces of land, part of which could be used for what we call IOS, industrial outside storage, which could be truck parking.
Right. Just stuff that someone that would rent one of these spaces would need. And then earlier I don't know if I understood that correctly, but did you say like kind of what also sets you apart is that you also invest your own capital, not just, your investors' capital, but also your own
Yes, yes.
capital? And
We like cash flow as much as anybody else. And so
right.
we typically put, depending on the size of the deal, 10 to 20% of the equity in every deal.
Yeah.
That's why I think that it proves that our alignment. We're sharing that risk with the investors. And we also have learned over the years not to borrow every last nickel you can from the bank. So we don't borrow more than 60 or 65%. And that
Okay.
allows us to always be able to pay the mortgage if I lose one or two tenants. So, we like to sleep at night.
Yeah, that makes sense. So you're not over leveraging is not part of the business strategy.
No, you can't because, in today's world, first of all, it doesn't make sense. Second of all, it exposes everybody to risk, which we don't want to do.
Yeah, right. Now, shifting gears a little bit to the more like a more general question, what are your, obviously we're in a higher interest rate environment, affecting valuations and cap rates and all those kind of things. What are your thoughts on like the current market, inflation, interest rates, things like that? And what do you kind of foresee here happening over the next 12 to 24 months?
Oh, I think what we're seeing now with the GDP, the economy starting to slow down and the effects that these tariffs are going to have, I think you will see some interest rate cuts. I listen to a lot of these financial channels in the morning on my way to work and on the way home, and some are saying one cut this year, some are saying potentially two cuts. I'm just hoping that the tariffs, if they stop waffling and they're actually there, they're going to affect building costs. They're going to affect food costs. And so I think that will slow the economy down, which will warrant these interest rate cuts. We're already seeing the 10-year treasury, I think, was down to 4.25 this morning. At one point, it was much higher. So mortgage rates are coming in, both on the commercial and the residential side. I don't see them going back to where they were 3 or 4 years ago.
Yeah.
That was too low for too long, and I think that's part of the problem. People drank the Kool-Aid. But I think that hopefully the economy, which is strong, keeps going forward. I just don't understand, and a lot of people don't understand what the current administration is doing with threatening tariffs, cutting the workforce, cutting some of the social programs that people need as far as Medicare and Medicaid, and how that affects certain markets more than others.
Yeah. Yeah, especially the tariffs they kind of seem to be going back and forth on those a little bit. So, but yeah, and then, we'll obviously link all your social media profiles down below in the description. But if someone wants to learn more about you and your company and invest, or at least get some more information about investing, where would be a good place to start for them? How can they get in touch with you?
The easiest place is you put my name in the search bar of Google or whatever your browser is, and it'll come up with websites, speaking engagements where I've talked about what I'm going on. You can find me on LinkedIn if you're there. I do respond to emails, whether it's on LinkedIn, and actually LinkedIn has my cell phone number, so I do get a lot of phone calls. So,
Okay.
It's part of my job is trying to explain to people what I do, talking to investors, talking to lenders, and some people just want a set of ears and eyes to say, I made this investment. What do you think? And unfortunately, with a lot of maturing loans that can't refinance, people have to make hard decisions. Do they throw good money after bad, or what do they do?
Yeah, right. Well, thank you so much for your time, Irwin. I really, really appreciate it. Thanks for the insight. And I will let you enjoy the rest of your busy business day. I'm sure there are calls awaiting from lenders, investors, and other people. So thanks for your time.
My pleasure. Thank you for having me.
Awesome. All right, podcast ends. If you want to stay on the line real quick. Well, first of all, thank you. That was insightful. I just always want to kind of next expectations for release and things like that. But before we get into it, is there like a newsletter that you have where you like, how do people usually, because I'd be super interested in, maybe exploring like an investment opportunity
No,
with
sure. If you just shoot me an email and I'll put you on the distribution list.
perfect.
And this way you'll get them when we send them out. Like we hang up. I think I have your email in the invite here somewhere.
Yeah, I'll send it.
And then I'll send you the current one that we're looking at in Ohio. It'll talk about what the value add is. And this, as I said, you find people that have old gross leases buying from the original builder, who's in his 70s, and he's got no mortgage on it. And for him, it's just about estate planning and moving on with the next chapter of his life.
Yeah, right. And sorry, go ahead.
We're never the highest buyer, the highest offerer, but with an offer that's going to close.
Yeah, as I know from the residential side, the highest offer is not always the best when you have
Correct.
a lot of leverage involved and shaky loans and stuff like that. And it sounds like you can really do a lot of damage with your offers because you're not over leveraged. You do have a lot of equity or skin in the game. And do you by chance know, I mean, this is off topic in a way, but I figured with your CPA background, do you by chance know if can I do a 1031 exchange into one of your investments? Like if I sell one of my...
On a large enough exchange, yes, we can give you a tick. Typically, the small couple $100,000, there's a lot of paperwork involved and some lender brain damage because when you have a tick from your exchange, you're considered also a borrower. And so not only are they going to underwrite me as the borrower, they're going to ask you for financial disclosure. And it's got to be a large enough exchange to make it worthwhile. But in my last deal we closed back in June, I had a fellow from California who actually is a music producer, has a lot of money in investments, and he came in as a tick. And good thing I knew his attorney in California. We're small world real estate, so he explained to him what the brain damage was, and I just spoke to him. He owns a lot of rental homes in Arizona, so he's got 3 of them under contract now to sell, and it's like, all right, so what's the next investment now?
Yeah, because that's the situation I'm in. I actually just went under contract on one of my properties last week, and typically I do 1031 exchanges, just the typical 1031 exchange. So I was just wondering if your investments could also be used, but I do not think I would meet your minimum requirement for dealing with all those headaches. So we might have to just do it the old-fashioned way. But yeah, put me on the distribution list. That'd be awesome. Oh yeah, and then as far as like next steps, so we release an episode every Friday. I think right now there's 1 or 2 episodes in front of you. So I think this episode will get released probably by the end of March on Fridays. It'll get released to Apple Podcasts, Spotify, and YouTube. And then Saturday, Sunday, or Monday, you will get an email from my podcast management team just saying, hey, it's released. Here's the link. And you will also get some marketing material like a reel, a quote card, a thumbnail, so on and so forth. That way you can also post it on your LinkedIn and your social media and things like that. And then if you see anything, when this gets released, like a link that's missing in the description or a typo or anything like that, just reply all to that email. I'll be on that email, and my editors and the podcast management team and all of them will be on the email as well. So we'll get that taken care of. And in the meantime, if you have any other questions or follow-up questions, just send me an email and I'd be happy to answer them. But shoot for kind of end of March for this to get released, either the last week of March or the week before that. Okay?
No, that's fine. That's great. Thank you.
Awesome. Well, thank you so much for your time. I really appreciate it. And we'll be in touch with this episode, and hopefully we'll be in touch regarding maybe some investment opportunities as well.
That's great. Thanks, Kevin.
Awesome.
Bye-bye.
You got it. Bye-bye.
And that wraps up another insightful episode of the 239 Real Estate Roundtable podcast. I hope you enjoyed our discussions and gained valuable knowledge to enhance your home ownership journey here in Southwest Florida. A big thank you to our incredible guests and, of course, to you, our listeners, for joining us. If you have any questions or topics you'd like us to cover, or if you'd like to connect, feel free to reach out. You can find us on Instagram at Kevin Tremmel _real estate, on Facebook at Kevin Tremmel Real Estate, or visit our website, kevintremmel.com. Don't forget to subscribe so you never miss an episode. Your feedback is crucial, and we're always eager to hear from you. Until next time, this is Kevin Tremmel, your host, signing off. See you on the next episode.